Hello and welcome to my first video on the ATS YouTube channel. My name is Greeny and I'm going to be going over a quick trade recap from Friday on Euro USD within my session in London. So we'll start from the left hand side, move away to the right hand side, and then we'll drop down into the 1 minute chart and go through the entry model. So first of all, I'd like to start with the CPI news from Thursday. We have the upward movement within the afternoon, creating a break of structure to the left hand side, causing us to have a now protected low from the impulse back and forth movement on the news. Usually in CPI we have seen it's gone in one direction, and instead this month that it's gone up and down to take buyers and sellers into the market and cause a heavy manipulation. I have seen a lot around on Twitter that people's accounts are getting blown purely because of the movement. Instead of anticipating the directional movement, it's taken both sides into the market. However, we come over here, we create that breaker structure like I mentioned, and then we create a market structure shift to the upside. This is just before the ADR opens. So when the ADR opens, it's created a downwards expansion, created a market structural shift to the downside, which you see here. It is very minuscule. It's 0.2 pips, I believe. Yes, 0.2 pips to the downside. However, with the ADR, the direction is bearish, so it's created a downwards expansion model. So for me to come into my session here when it just closes, I do understand that we still have the downwards expansion movement, and it can still be used in between the ODR closing and the ADR creation within my session or previous session, which was from 7:30 New York Standard Time to 8:30 New York Standard Time in the evening. So when we come into here, we look at what price is doing in regards to the previous DR model. So here we'd already had this downwards movement, but nothing significant was in here for me. The next significant area was the equilibrium of the ADR, which I see as a liquidity point. However, when we come down to the 1 minute chart, there isn't anything here that fits my entry model, and I'll show you why. So I use the OTE, the optimal trade entry model from ICT himself. However, when I come back into this area, the 0.62 and the 0.79 area, I'm looking for price to close, have a reaction, and then close back down under the 0.62 area. However, in this case, price just ran up. It reacted with the extreme point of the leg, which was on the 1 minute, and then broke above, which then invalidated the equilibrium point on the ADR. So now we come into here, the 0.79 area, which the master teaches as the retirement setup. Anything above here is something that you will look to short, in this case, to the low of the ADR session. So in here we have my entry model, which I'll start from the beginning. We have market structure shift to the upside, market structure shift to the downside. However, this isn't the market structure shift, it will be this one, because prices failed to close below on this candle, but 2 candles later it does. It pulls back up, however does not really give a significant move back up for me. I wanted to see price fall further down, take these sell stops into the market, there, and this has already done it. Then we pull back into here, and then, which is the 0.62 area, and we close. So it was more this. No, wasn't. It was the previous one. What's the previous one here? Because I got in at 901 on this candle here. So as we see, there was the market structure shift. The OTE was met at the 0.62. And it wasn't the best entry, I will admit. It wasn't the optimal trade entry, like Michael ICTE says. But I understand that it's had a reaction in this point and it wants to break down. Price is showing me that it wants to break down and doesn't want to continue to push up like it did here, which means we have more of a probability that it's going to continue down. So we get into here, we take the market entry. I do use the trade assistant, which is something that really helps me to maintain my risk management, and it prevents any problems with sizing, or if I have to look at a position calculator when I'm working on the 1 minute, it doesn't work. You just want to have the optimal entry when you're taking the market and market execution. So push down, push back up. When this is created here, this area here, and you have this downwards, massive downwards expansion in the first half an hour of the hour, you then see price ends up coming down to react, which in my opinion, there is buyers. We look to the left, we've still got this movement from here on the Thursday afternoon. So there's going to be people protecting these points and the buys up. So this movement up to me was just a mitigation on this leg, which you can see more clearly on the 5 minute. All it's done is come back to mitigate this area here. You see the fair value gaps, or the imbalances, whichever you like to call it, that are here. So then we push back up, mitigate off a fair value gap just below the order block, and then we push back down. We will break even at this point, even though we do look to take profit just as soon as the low is taken. However, the risk to reward for me was a bit too small, and I do have a minimum of 2. However, if it was to break down here, I wanted to target 2.5, and that was just purely the reason. Before I got into the trade, I knew I was going to be targeting the 2.5. So I break even here, so I know it's already hit 2.2, yes, just short of 2.2R. So I don't want to risk getting stopped out and taken up now for the additional 0.3R. I am willing to risk the 2.2, which I've already accumulated in equity, for the additional 0.3R at this point, due to the high probability of price coming down to take some of these orders, the sell orders or stop orders, into the market. So yeah, that was just a quick breakdown. It was the first video, so any feedback that is welcome towards this. So thank you.